$2 million invested writes about $6,500 a month, and it writes that check whether you get out of bed or not. The median American working full-time earns $1,204 a week. That is the Bureau of Labor Statistics annual figure for 2025, and it works out to roughly $5,217 a month, gross. So a $2 million portfolio out-earns the median full-time paycheck by about $1,280 a month, permanently, with no commute attached. Run that backward, and you get the crossing point. $5,217 a month is $62,600 a year. At the withdrawal rate, Morningstar published for 2026 3.9%. You need about $1.6 million of invested capital before your portfolio writes a bigger monthly check than the median job does. That is the number most people carry around. It is also the wrong number, and it is wrong by more than $500,000 because it quietly assumes your portfolio is the only thing depositing money into your account. It is not. The average retired worker benefit in 2026 is $2,071 a month after the 2.8% cost of living adjustment that landed in January. Stack that on top of the portfolio check and the arithmetic changes completely. Now, your portfolio does not need to produce $5,217. It needs to produce $3,146 because the other $2,071 is already arriving. $3,146 a month is $37,752 a year. Divide that by 3.9%, and the crossing point is about $968,000, under $1 million. The threshold where your investments out-earn a median full-time paycheck sits below the roundest, most famous number in personal finance, and a meaningful number of people watching this are already standing on the other side of it without having noticed the moment they crossed. Before we walk the rungs, you need to know what 3.9% actually is, because everything downstream depends on it, and almost everyone misuses it. It is a starting rate, not a yield. It is not what the portfolio earns. It is the slice you take out in year one and then adjust for inflation every year afterward, sized, so that a 30-year retirement holds together in the large majority of modeled outcomes, with somewhere between 30 and 50% in stocks. Morningstar published 3.9% for 2026, up from 3.7% for 2025, and the same research series has been as low as 3.3% earlier this decade. It moves because bond yields and stock valuations move. Hold on to the phrase starting rate. It comes back later, and when it does, it is worth more per month than another year of work is. The reason we are anchoring on a rate at all traces to one man on one date, in October of 1994, a financial planner named William Bengen published a paper in the Journal of Financial Planning. He took a portfolio of stocks and bonds, ran it against every retirement start year going back to 1926, and asked one question. What is the highest first-year withdrawal you could have taken, adjusting for inflation, without running out of money over 30 years? The answer that survived every single historical start date was 4.15%. The industry rounded it to 4, printed it on 1 billion brochures, and turned one man's backtest into a natural law. Bengen never claimed it was a guarantee. He measured the worst case in a specific data set and reported it honestly. Everyone downstream dropped the honesty and kept the number. Since we are on the subject of turning a rate into an actual exit date, I put together a digital book called The Exit Code that does exactly that conversion. It takes the withdrawal math you are about to see and connects it to a date on a calendar rather than a feeling. It is in the description if that is useful to you. Now, the latter and the first rung is where most of you live. $800,000 invested at 3.9%, writes $31,200 a year. That is $2,600 a month. Add the average benefit of $2,071, and the household is receiving $4,671 a month against a median paycheck of $5,217. You are $546 short. That is the whole gap. Not a lifestyle away, not a decade away, $546 a month. Sit with what that does to the meaning of your job. At $800,000, your job is no longer paying for your life. Your portfolio and your benefit are covering the equivalent of 89% of a median paycheck. The job is covering the last 11%. You are working a full week to close $546. That is not a moral judgment about work, and plenty of people genuinely like what they do. But the honest description of the role has changed. You are not a provider anymore. You are a gap filler. And once a job's economic function is measured in hundreds of dollars rather than thousands, the calculation of whether to keep doing it changes with it. Push to $1.2 million. And the portfolio alone writes $46,800 a year, $3,900 a month. Stack with a benefit, $5,971 a month against $5,217. The gap flips. You are now $754 a month ahead of the median paycheck, and you crossed somewhere back near that $968,000 mark without a bell going off. $754 is a real margin, but it is not a comfortable one, and there's a reason it looks thinner than it actually is. We have been comparing the wrong units on the paycheck side. A paycheck pays FICA. 7.65% comes off the top for Social Security and Medicare before a single dollar of income tax is calculated. On $62,600 of wages, that is $4,790 a year, about $399 a month, gone before the paycheck is a paycheck. A portfolio withdrawal pays none of it, zero. There is no payroll tax on money leaving a brokerage account or a retirement account, because payroll tax is a tax on labor, and selling shares is not labor. So the honest paycheck line is not $5,217. It is $4,818, and the crossing point drops again, from $968,000 to about $845,000, purely because we stop comparing a number that has already been taxed against a number that has not. Hold the word gross. We are going to come back and settle it properly. The top rung first, because it reframes the two below it. $2 million writes $6,500 a month on its own, and $8,571 with the benefit stacked. Against a median paycheck, that is a surplus of $3,354 a month. At that level, the job is not filling a gap. It is decoration. Every hour worked is producing income the household already had. And the only honest reason to keep going is that you want to. Now, how rare is any of this? The Federal Reserve Survey of Consumer Finances puts median household net worth for people aged 55 to 64 at $364,500. That number gets quoted constantly as though it were a portfolio. It is not. Net worth includes the house, the cars, the small business, the equity and rental assets that show up on a balance sheet and write no monthly check. A paid-off home produces exactly $0 a month in deposits. It reduces expenses, which matters enormously, but it does not appear in the comparison we are running because the comparison is about what lands in the account, which means the check-writing portfolio at the median is far smaller than $364,500. And every rung on this ladder is rarer than the net worth headlines make it sound. If you are on one of them, you did something the majority did not do. Hold that thought because it is going to matter in about 10 minutes when we ask whether crossing this line is worth defending. Look at the spacing between the rungs though, because the spacing is where the whole video turns. Going from $800,000 to $1.2 million costs $400,000 and buys $1,300 a month. Going from $1.2 million to $2 million costs $800,000 and buys $2,600 a month. Same exchange rate both times. At 3.9%, every additional $100,000 of portfolio buys $3,900 a year, $325 a month. Flat, it does not accelerate. There is no rung where the math suddenly rewards you more per dollar, $325 per 100,000. Remember that. Right now, it is arithmetic. Later, it becomes a decision. By the way, clicking subscribe genuinely helps this channel keep doing the boring reading, so thank you to everyone who does. Here is where the ladder stops being the story. Take the same $3,900 monthly withdrawal, the one that comes off a $1.2 million portfolio, and send it out 3 different doors. Door 1 is a traditional 401k, or a traditional individual retirement account. Every dollar out is ordinary income, taxed at your ordinary rate. The same schedule, that taxes wages. Door 2 is a taxable brokerage account. You are not withdrawing income, you are selling shares, and only the gain is taxable, and long-term gains run on their own schedule below ordinary rates, and at a modest taxable income, that schedule starts at 0. Not low, 0. Door 3 is a Roth. Nothing. No federal tax on the withdrawal at all. The same $3,900, 3 doors, 3 different amounts landing in the checking account. And the spread between those doors is wider than the spread produced by another $100,000 of balance, which means the crossing point is not only a function of how much you saved, it is partly a function of where you put it, a lever you own today that costs no additional years and no additional dollars, and that most people never touch because they were told to think about the balance and nothing else. That is the shift. This was never a video about the size of the pile. It is a video about what reaches the account, and the doors interact with the second income stream in a way that catches people. Social Security is taxed on something called provisional income, roughly your other income plus tax-exempt interest plus half your benefit. Above $25,000 for a single filer or $32,000 for a couple, part of that benefit becomes taxable, up to a maximum of 85% of it. So a traditional withdrawal does not only get taxed itself, it can reach across and make your Social Security check taxable too. A Roth withdrawal does not raise provisional income at all. The two streams are not independent, and the account you draw from decides how much they collide. The benefit shrinks on its own as well, before any of that. The standard Medicare Part B premium for 2026 is $202.90 a month, and it is deducted directly out of the Social Security payment. Nobody sends you a bill. The check arrives smaller. So the $2,071 we have been stacking on every rung is not what lands. What lands is closer to $1,868. That sounds like the thesis collapsing. It is not, because the other side of the ledger restores more than it takes. A retiree age 65 or older gets a larger standard deduction than a worker does the base amount plus an age add-on on top of it. So a slice of ordinary withdrawal comes off before the first dollar of federal tax is assessed. A worker earning wages gets the base deduction and pays FICA on everything from the first dollar. A retiree drawing from a traditional account gets a substantially larger deduction and pays no FICA at all. That is the last of the tax mechanics. Everything from here is comparison and consequence. Here's the part that never makes it into a retirement calculator, and it is the reason I built something beyond one. A calculator gives you a number. It does not tell you which account that number should leave from, what happens to your benefit when it does, or how to keep the plan intact in a year when the market is down 18% and your withdrawal is scheduled anyway. I put together a digital book called The Exit Code, 8 chapters of actual research, built on 50 years of retirement data rather than opinion, distilled into a mathematical framework that turns maybe someday into a specific date. 2 pieces of it are directly relevant to what we are doing here. The first is the 4% trap and the dynamic withdrawal method that replaces a rigid inflation-adjusted number with rules that respond to what the portfolio actually did. The second is the Social Security bridge, how to fund the years between leaving work and claiming, so that waiting is a choice rather than a luxury. It costs less than a dinner out, through the link in the description. Time is the thing applying pressure here, not me. Now settle the crossing properly, landed against landed. On the Paycheck side, $62,600 of wages loses $399 a month to FICA, and then pays ordinary income tax on nearly all the rest. On the portfolio side, the first slice of ordinary withdrawal comes off under that larger deduction. Capital gains can be taxed at 0, Roth dollars are taxed at nothing, and no payroll tax applies anywhere. Meanwhile, the second stream lands at $1,868 after the Part B deduction. Run it. The portfolio needs to cover $4,818 minus $1,868, which is $2,950 a month, or $35,400 a year. At 3.9%, that is about $908,000. And for anyone holding a meaningful share in Roth or taxable accounts, it sits lower still, because the Paycheck side is being taxed harder than the withdrawal side at every level. So the answer to the title is roughly $900,000, not $2 million, not the $1.6 million the gross comparison suggested. About $900,000 of invested check writing capital is where the money you already have out-earns the median full-time paycheck once both sides are measured the same way, which raises the question the whole thing was actually about. If you are past that line, what is another year of work buying? We priced it already. Every additional $100,000 buys $325 a month permanently at 3.9%. So a year in which you save $40,000 and the market cooperates might move your monthly income by $130, maybe $200 with growth. Put $325 a month on an actual Tuesday, because that is the unit that matters. It is dinner out twice. It is a better seat on one flight a year. It is the difference between the mid-tier grocery run and the one where you do not check prices. It is real money, and I am not going to pretend otherwise. But the price is roughly 2,000 hours of your life in the decade where your knees, your parents, and your grandchildren are all making competing claims on your calendar. 2,000 hours for a slightly better Tuesday. You can decide that trade is worth it. You cannot pretend you do not know the exchange rate now. And there is a second cost people miss. 3.9% was solved for a 30-year retirement. Start at 62 and you are funding 30 years. Start at 67 and the money has a shorter horizon to cover, which means the sustainable rate on that same pile is higher than 3.9, not equal to it. Waiting does not only add contributions, it shortens the window the rate was built for. The extra year is not a free carry in either direction. It changes the input, and both changes are smaller than what is sitting on the table right next to it. Because remember what 3.9% is. A starting rate, chosen for someone who will spend the same inflation-adjusted amount every year, regardless of what markets do. That rigidity is what makes it low. The same 2026 research finds that a retiree willing to adjust spending in bad years, a guardrails approach, where a poor market means a genuinely smaller year, can start meaningfully higher than that. At $1.2 million, 3.9% is $3,900 a month. A higher starting rate on that identical pile is a bigger deposit every month, available today, requiring $0 additional dollars and $0 additional years, and costing only a commitment to cut spending in the years when the portfolio has a bad run. That is not a free upgrade, and I would be lying if I framed it as one. Flexibility means you actually have to be flexible, which means a year where you skip the trip, and that is harder than it looks on a spreadsheet when the trip has been on the calendar since March. But look at the two levers side by side. One more year of work, about $325 a month, purchased with 2,000 hours. A willingness to spend less in bad years. Several times that, purchased with nothing but the honesty to write the rule down in advance. So why does almost everyone still work the extra year? Not for the income. Nobody grinds out another 12 months for $130 a month. They do it for safety. The year is not bought as income. It is bought as insurance, a cushion against the possibility that the models are wrong, that the market turns, that the number was never quite enough. And that instinct comes from somewhere reasonable. The advice industry is not staffed by villains. An advisor paid 1% of assets under management earns more when your balance is larger, and larger balances come from working longer and withdrawing less. So the counsel to keep accumulating is both genuinely conservative and structurally profitable. And almost nobody delivering it experiences those two things as being in conflict. Your 401k provider, your employer, the plan administrator, every one of them has a workflow designed around the accumulation phase. And not one has a form you can file that says, my portfolio now out-earns my salary, please advise. The incentive is not to mislead you. The incentive is that nobody's job description includes telling you when to stop. But the safety argument has a hole in it. And the 2026 Retirement Confidence Survey from the Employee Benefit Research Institute, fielded in January of this year across more than 2,500 Americans, is where the hole shows. Workers report a median expected retirement age of 65. Retirees report a median actual retirement age of 62. And nearly half of them left earlier than they had planned to, not because they chose an earlier date, but because health or disability or their employer made the decision on their behalf. Read that against everything we have built. Every rung on this ladder, every tax door, every comparison of levers has been quietly assuming that the extra year is something you get to buy. It is not a purchase. It is a coin flip with a 3-year bias against you. The average person planning to work until 65 is describing a date that, statistically, arrives 3 years after the one they will actually stop on. So $325 a month was never merely a small return. It was a small return on a year that roughly half of retirees never received. You're being asked to pay 2,000 hours for a Tuesday upgrade on credit from a lender with a documented history of not delivering. This is where the reflex that built your portfolio turns on you. For 30 years, the correct instruction was the same every morning. Contribute more, spend less, do not fall behind. It worked. It is the entire reason you are near a $900,000 crossing point instead of the median. But at some point along the way, the instruction stopped being a strategy and became an identity. You became the responsible one. And the responsible one experiences a reduced contribution as recklessness, even after the arithmetic has clearly stated that the contribution's original job is finished. That is not a math error. It is a brain problem wearing a math costume, and it is the most expensive one in this entire field, because the currency it charges you in is years, and the invoice never arrives in dollars. Naming the new role is the whole job. The old one was Accumulator, and it was measured by how much went in. The new one is Allocator, and it is measured by what lands and when, which door the money leaves from, which year you convert in, when you claim, how flexible you are willing to be. Lazy investing built more fortune than crypto memes. And the laziest, highest return move left on your board is not another year of deposits. It is noticing that the deposits stopped being the point. $900,000 of invested capital drawn at 3.9% and stacked on an average benefit that lands at $1,868 after Medicare takes its cut, out-earns the median American full-time paycheck once you measure both sides after payroll tax and after the deduction a 65-year-old actually gets. That crossing is real. It is roughly $700,000 below the gross number people quote. And given what median net worth actually looks like at that age, arriving there is not a formality. It is the rare outcome. Past that line, another $100,000 adds $325 a month. That is the exchange rate. And it does not improve at any balance. Somewhere between the rung you are on and the next one, another year of work stops buying a better life and starts buying a marginally better Tuesday one you are paying for with a year you might not get to spend either way. The portfolio already knows the answer. It has been writing the check the whole time.